But for those of you on Facebook Live, in our Barley Marketing Group, thank you guys all for being here. Scott, the easiest thing to do is usually go like this, and that way you can hear them and talk to yourself at the same time. So we're still working on trying to puzzle piece it together between Zoom and between Facebook Live and to be physically here. So our Monday Lunch and Learns, we are getting slowly better into it. We're trying to orchestrate this whole environment. So at the same token, for those of you if you can't see, you can shift over to here. Scott doesn't bite. I'm pretty sure of it. I've now coached with him several times, and I'm pretty sure he hasn't bought it. Right? What? No, stand over here if you're going to sit over here. Just because he's going to be here. Yeah, he's going to be over here. So Scott and I have been working together for the last couple of years. We've known each other from when I was at Keller Williams, and then the Up Network, and then now here at the Barley Market. So he brings a unique perspective for buyers and the opportunity that sometimes the traditional sales of buyers don't always happen, and you have to be creative. And he's a genius behind some of these strategies and plans that he puts into play. So it's very important that sometimes when a buyer says to you, I can't do this, or I literally was talking to somebody in New York. Do you do New York? You don't do New York, but do you know somebody in New York that possibly could do something? He could find somebody. Well, the key concepts is like, don't always say that, okay, sorry, buyer, you can't, this isn't going to work for you. There's ways that we can get them or make things happen for them. And Scott has these plans, these strategies. We always talk about engagement. So if you have questions, he loves questions, but it just makes it more informative the more questions you have to understand. And I'm sure maybe you're going to talk about bank statements. Is that one of them? One of them, bank statements. Being a 1099, it's very hard. When I had to go buy my house, it's very challenging when you're a 1099. So you have to have different unique ways to be able to do that. So without further ado, I'll let Scott handle it. If you have anything, for those of you who are online, just ask us a question online or send me a text message. I'll make sure that Scott gets it. And for those of you on Facebook, I'll be following it on Facebook to let him know. So in case there is something, I'll let you have it. All right.
All right. I appreciate the nice introduction, Brock. This is kind of weird because I sound like to myself, I sound like I'm in a submarine because this thing's on. But anyway, it's all good. My name's Scott Hastings. I'm with Angel Oak Home Loans. I've been in the mortgage business since about 2003, except for a little bit of period. I don't know if y'all remember, there was a slight market correction in 2008. So I was out of the market for a little bit there. But anyway, I've been back for quite a while. And like Brock was saying, please ask questions because this whole topic is very open-ended. I think one thing I tell people all the time that I'm talking to in the mortgage business is there's no common sense in the mortgage business. I don't know if you talk to clients much about mortgages, and they probably get very frustrated a lot of times. They get frustrated about a lot of things, I guess. But they many times, of course, will try to bring common sense into it. Well, that doesn't make sense. You can't think about it that way. The mortgage business follows certain guidelines, and it doesn't really matter where you go. If you go to Bank of America or wherever, they're all underwriting their loans to the same guidelines. Fannie Mae, Freddie Mac, FHA, USDA, VA, what have you. So a lot of times I'll talk to borrowers or talk to agents that have been talking to borrowers, and they'll say, well, or they'll call me and say, I'm trying to find a lender that will do this. And I'm like, you're not going to find them because we're all underwriting the same guidelines. But kind of what I have found a niche in and specialized in is self-employed buyers. And I'm sure everybody has had a issue of some sort with a self-employed buyer along the way. They're perfect on paper. They go look at the house, they have a ton of money in the bank, but they can't get a mortgage. So these specialty products that I'm going to talk about is where I would come in with something like that. You know, lately, since the pandemic started, all these kind of mortgages for a little while just went away. And then over the last 3 or 4 months, they've started to come back, and maybe every month they'll loosen the guidelines up a little bit more and a little bit more. So they're almost back to where they were. But since interest rates have been so low, I mean, 98% of what I've been doing is just regular old loans. And that is what you want to do for somebody, ideally at first. So if a borrower calls me, and I get these calls a lot, and they'll say, I'm self-employed, because they'll find me online or whatever. I'm self-employed, and I know I need somebody like you to do a loan. I always say, well, first, have you talked to somebody? Has anybody reviewed your tax returns? Are you sure you can't do this? Because a lot of people just assume they can't. So the first thing I want to do is I want to get their last 2 years of tax returns. I want to look through everything. I want to look at all the different ways you might possibly be able to do it, you know, traditionally, because the interest rates are at least twice as much on a portfolio loan. And I would say 30% of the time I find a way to do that. Anyway, something happened here. Something in my earpiece. I'm sorry. The interest rates on a portfolio loan. Okay. The other one. Okay. Okay. All right. Yeah, that's much better. So interest rates on a portfolio loan are at least twice as much as they are on a traditional loan. But what you'll find is if somebody has exhausted their possibilities, they know they're not able to get a conventional loan, they don't really care what the interest rate is, because they know it's way cheaper than paying tax. I mean, most self-employed people run their business that way, and it's way cheaper, you know, to pay 6 or 7% on a mortgage than it is to pay $100,000, you know, in taxes. So anyway, I'm going to try and pull this together into a cohesive talk. Somebody asked a question before this, and I've gotten this question more lately than I have in a while. I get a lot of calls and people say, I have a customer, they have a new business. It really doesn't matter what kind of mortgage you do, except for one, and I'll tell you about that one. You have to have 2 years of self-employed income. If that's a conventional loan, Fannie Mae, Freddie Mac, whatever, bank statement loan, because really that's sort of a basic underwriting guideline. They want to see that the business has stability. So somebody could open a business and just have a killer year, but they don't really have any stability, then it goes away. So they want to show that continuity of income. So that's sort of a very basic thing about self-employed people. So we'll take a hypothetical situation. Customer, we've looked at their tax returns. We know that they can't qualify traditionally. So the first thing we might want to look at is a bank statement loan. So a bank statement loan is exactly what it sounds like. Instead of looking at tax returns, we don't even require tax returns. We don't even care if your tax returns are filed. We get either 12 or 24 months of business bank statements, and we'll take all the deposits, add them up, and typically take 50% of those deposits, and that'll be considered your income. You know, divide it by 12 or divide it by the number of bank statements to get your monthly income. Typically, I find that people have plenty of deposits. What I do come up against is people don't have enough down payment. So the difference between a portfolio, bank statement loan and a traditional loan is right now the minimum down payment is 15%. You have to put at least 15% down or you just can't do it. And plenty of people have that. Plenty of people have the cash to put that down too. The next thing I run up against sometimes, and I have more recently, is you have to have a certain number of trade lines. In other words, a trade line is a car loan is a trade line. A credit card trade line. You know, you have to have a certain number of trade lines that have been open and active for at least 12 months. And sometimes I see people that they just use a lot of cash. They just they don't believe in credit. Well, then they don't believe in getting a mortgage. You know, that's a problem. So you're not going to know that, but that's something else, you know, that I have to look for. And I don't want to get too mortgage deep into this, but all mortgages talk about debt to income ratio. So, you know, debt to income ratio is the percentage of debt you have in comparison to your income. Very basic. A bank statement loan is going to have a 50%. So 50% of that income can go towards total debt. Really, you can go up to 50 if somebody has very good credit and money in the bank. Even on a conventional loan, you can go up to 50, to tell you the truth. And an FHA loan, not to get into this, you can go to 56. So that's traditionally what it you know should be. That's what they call a qualified mortgage. Can't go over 43. But so a lot of times when people hear about these products, they'll call me and say, I've got a buyer. If they couldn't qualify, could you do them? Because what they hear when they hear bank statement loan or a portfolio loan is subprime loan. These are not subprime loans. So these loans actually perform better than most, definitely better than FHA loans, and probably as good as conventional loans, because all these loans, they have at least 15% down. So they got money in the bank, and the credit is, you know, our minimum credit score right now is a 660. Yeah, 660. And it will go back to 620 is where it was before, but right now it's a 660. So these are not subprime borrowers. These are borrowers that just take advantage of the tax laws and write off all their income. There's also the borrower that they are maybe over the loan amount for an FHA loan. FHA minimum or maximum loan amount is like 330. So we also have portfolio loans for somebody. Let's say they need a $500,000 mortgage, but they had a bankruptcy 3 years ago. We'll do that loan. So if they had a foreclosure, if they had a bankruptcy, you know, that's at least 2 years old, that's not a problem. And we'll do those loans up to like $3 million. So I've done quite a few loans like that. And then a guy just closed last week. I did a loan for him 3 years ago, I think. He bought a house, I don't know, $600,000 or $700,000 house. And now his time period's passed, and we refinanced him on an FHA loan because he had over 2 years had passed. He put like, you know, $300,000 down to make the loan work. But, you know, he went from 8% to like under 3%. He inherited this money. So anyway, he inherited the money. So let me give you his number. No, I'm just kidding. So anyway, but I mean, it's amazing to me, and probably y'all see it too. I mean, how much money is out there? You know, there's plenty of people in this area with a lot of money, and they didn't get it. You know, a lot of them by paying taxes. So I closed a loan for John back in December. Guy bought a $2 million house, and I got him a loan. No, I got him a $2 million loan. I'm sorry, with bank statements on a $2.3 million house. That's probably the biggest, definitely the biggest bank statement loan I've done. But I mean, it's not unusual. Most of these buyers are buying much larger properties than your typical buyer to the portfolio loans. Yeah. So any questions on the bank statement loans? Kimberly or Philip? Guess not. Does that all make sense for the most part? Okay. So another kind of loan that we have is for investment properties. So if somebody, first of all, somebody has to own their primary residence. And I'll get calls, people say, I have somebody who wants to buy an investment loan. And it's amazing to me, people want to buy investment properties and they rent their current home, but you can't do that. the reason is these investment loans on investment properties, they don't have any income listed at all. So all you have to do is have credit and 25% down. And you can do this loan. And those would go up to like $1.5 million more by exception. But it's probably going to have a 6 or 7% interest rate, and people obviously balk a lot at that. I might have one of those going right now. But the people that don't balk at that are professional investors, because once you get past probably 10 loans, 10 houses with mortgages on them, Fannie Mae doesn't want to do those. And really, most people don't want to do them, mainly because it's just a paperwork nightmare, because you have to get all this paperwork, tax returns on 10 different properties. So, and the investor doesn't want to deal with it. So that's an ideal person for something like this. They just want to close on a loan. They don't care what the interest rate is, as long as it cash flows. And so it's called a cash flow mortgage, investor cash flow. The only real guideline, besides, credit, and that you own your primary residence. I'm sorry? It's called investor cash flow. And the first one that I talked about was the bank statement loan. Oh, sorry. You have to have credit. And the second thing is it has to cash flow. So when the appraisal is done, the appraiser does a schedule of rental analysis, and the rent, the fair market rent, has to be at least what the mortgage is going to be. So the mortgage payment can't be more than the fair market rent. That's right. Exactly. Yeah. Right. So the question was, it doesn't matter if a tenant was in there, right? So what the appraiser will do is he'll basically just look at rental properties in the area and no. So it doesn't matter once the tenant is in there. The interest rate is the interest rate. There's really not any positives to that high interest rate. It just is. I'll tell you one positive is that you can close in a name of an LLC. So you can't do that on a conventional loan. An LLC can't own it, and you can't title it. Now, people do that after closing a lot of times, but with this loan, you can. Now, the mortgage is still going to be in the person's name and social security number, but it can be owned in the name of the LLC. Any questions on that? No. Yeah. Okay. If he can handle that interest rate. So anyway, but so that's another one of our portfolio loans. Okay. It's going to be on a social security number. So if somebody really wants to get a loan in their tax ID name or tax ID number, that's a commercial loan. Yeah. No. And typically when I see those, I'll see those investors, and I'll do some loans for them, but usually they'll have like a blanket mortgage, they'll buy a portfolio of properties, like 6 properties, and it'll all be on one mortgage, a commercial loan. So yeah. No, that would be a fix and flip. Yeah. No. Yeah. The question was, can you borrow more money and so you can use that to fix up the property? But yeah. So this next loan is probably, I've done a lot of these loans, and this is where I talk about it's amazing how much money people have. And tell me when I'm running out of time. But if I'm running out of time. So This is a guy, I'll just give an example. This is a guy, he was a C-level executive for a company for like 20 years. I mean, he made like $1 million a year. He made a ton of money. But he had recently left that company and started his own consulting firm. So maybe he'd been doing consulting for 6 months. There's no mortgage in the world that he's going to be able to get. But he had plenty of money, in the bank and investments. So this is called an asset qualifier loan. So if somebody has, the rule of thumb is $500,000 after closing in liquid assets, stocks, cash, whatever, something can be easily liquidated. Then we don't have any income on the loan. You just put the down payment down. There's no debt to income ratio. That's fine. So he's qualifying all of his assets. And I've done quite a few of those loans. And I think you'll run across people like that for sure. That's your sort of after closing, yeah. The minimum down payment on that loan is 25%. So, there's plenty of people around here who, maybe serial investors, or serial entrepreneurs, and they have plenty of cash. Or, another thing I've run up against is somebody just changes the nature of their business. So have a guy, he owns a big insurance agency, and the income still comes in, but he basically stopped doing business under one S Corp and started another S Corp, and all the business goes through that S Corp. Well, you have to have a 2-year history of the S Corp. So even though his business really didn't change, his company changed. So you don't have any choice. I mean, he either has to wait the 2 years and get a traditional mortgage or do something like this, No, you don't have to have anything. You don't even list the job, you just put, just $500,000 cash. That's it. Yeah. Real minor. Yeah. Not a problem. Yeah. Yeah. So I'll be taking applications after this. But yeah, so really, you'll run up against those kinds of people for sure. And these people don't know this exists. So, when I'm talking to somebody, I just start to ask questions, just tell me what you're trying to do. And then they start to tell me, and then, it just sort of unwinds until we get to the right answer. So I guess what I'm saying is, if somebody tells you they can't get a mortgage, that's not necessarily true. Now, if they say they can't get a mortgage because their credit's horrible, that's true. They can't get a mortgage. Right. Even if you still got to have good credit. What I tell people in general is, if you've got credit and money, there's a way to do it. I mean, if you have no credit, well, that's not good. But the calls I get sometimes are people that have bad credit and no money. They're just totally out of luck. Yeah. Lose their number. Don't get me started. But one thing, you're a new agent. I know you say you're a new agent. As a mortgage person, obviously never put anybody in your car that hasn't been pre-qualified. But what I notice, and I think Brock might see this too, is newer agents that are so hungry to work with people, they want to fix their credit, they want to fix their life. That's a waste of time. I hate to say it, but it's true. Of all the people I send to credit counseling, I can count on one hand how many people came back and did it. Because most people that have bad credit are always going to have bad credit. It's their habit. It's whatever, it's something wrong with their soul. They're just not good at paying bills. So anyway, that's off topic, but I think that's good advice. Another loan that we do, there's a portfolio loan, but it has nothing really to do with this. It's a jumbo loan. I mean, we have a really, really good jumbo product. Our rates are, they're there with everybody else, with the banks and everybody. It's really probably the same guidelines as everything else, but especially in the pandemic, a lot of jumbo investors have pulled back. You know, we'll do, the rate is not good, but we'll do 90% on a jumbo loan, you know, 10% down, up to $1 million. You're going to pay for that. But if somebody's doing a regular 80%, you know, 20% down, I mean, I've seen rates in the last 3 weeks under 3, you know, I mean, on a jumbo loan, which is, it's pretty aggressive through us. Yeah. This is our portfolio. Angel Oak is, it's basically, it's a hedge fund. So we have a capital side. What we're doing when we're generating all these loans is we're creating mortgage-backed securities. So we bring these loans in, Angel Oak securitizes them so they can be sold to investors. So they have all these different hedge funds and stuff. So anyway, that's what Angel Oak really is. Trying to think if there's anything else. Mhm. Yeah. Right. Yeah. 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 So that's a good question. I'll just kind of give a background of how that works. So if somebody calls me up and we go through, I said, maybe you can do a bank statement loan. So I'll send them like a Dropbox link and I'll just say, send me your last 12 months of business bank statement. And I just go through them. And so what we're, transfers are not allowed. So if you transfer money from one of your accounts to another account, that doesn't count. Anything that's like really abnormally large, like if most of your deposits are, you know, between $1,000 and $5,000, and all of a sudden you got a $50,000 deposit, they're probably not going to count that unless you prove where that came from. but yeah, we're just adding up all the deposits that can be used, and we take 50%. Sometimes we'll take less. The reason we take 50% is because the other 50% is your cost of doing business. But if you're an at-home business, you don't have any employees, then we can do 30%. So we'll take 70% of the deposit and count that as your income. Yeah, I'm trying to think. No, because that would be on the tax returns. So what they figure is any deposits in there, they're being taken account of. And so if you have rental properties, it's just going to have to cover those mortgages too. But really, you know, when you look at somebody's return for an investment property, you're going to get way more. You're going to get way more bang for your buck by using the deposits because they really have so many write-offs. I mean, that's something to also look at. When people fill out applications and they put rental property, they always put the difference between the rent that they're receiving and their mortgage payments. Say, well, that's how much I make. But after all your write-offs on your tax return, there's plenty of times that turns into a loss, you know? So anyway, that's another, yes. I've got a client right now that does that, but I don't know how that works. They pay cash. I'm not sure how that would work. Right. Yeah. Yeah. I just saw that recently on somebody. They owned a couple of properties in their 401k. And what we also didn't hit them with the insurance and the taxes, and you know what I'm saying? So it's just, yeah, yeah, yeah. I think that is pretty sound strategy around here. Everything's appreciating so much. The question was about buying in a 401k. Not my, I know it can be done, but I'm not sure how to do it. So for a financial advisor. Anybody have any questions? I mean, any kind of mortgage related, because I don't think if I have any good tips or tricks, you know, that I haven't covered. we'll talk about one thing and then I'll wrap it up. So the pandemic has created a lot of people going into forbearance on their mortgage, right? And I was seeing a lot of that on credit reports. I'm not seeing quite as much now, but the rule is if you entered into a forbearance and you want to get another mortgage or refinance, you either have to pay up all the payments that you missed and bring it current, or wait until the forbearance is over and make 3 payments on time and then wait another 3 months, or so basically 6 months before you can get another mortgage or refinance. So that's kind of created a little bit of an issue. But I've had quite a few of those, and people just pay it up, I mean, that's what you got to do. Yeah. And putting in. Yeah. Yeah. Oh, yeah. I've had quite a few people, they didn't know they were in forbearance, right? But they were. But as long as you've also been making the payment, it doesn't matter. That's fine. Yeah. 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 All you have to do is show that you made the payments, and it really doesn't matter. Yeah. Yeah. And it for car loans, that's okay. They don't make you catch those up. You you still have to qualify with the payment. But yeah. Um, yeah. Yeah. It doesn't, you don't have to take those out of forbearance. They're just going to still hit you with the payment. What I've seen is it's just from lender to lender. I talked to a guy the other day, and he was like, first they gave me 4 months, and now they're, yeah, I think they're just let's make a deal kind of thing. Yeah, yeah, yeah. I mean, the people I talk to, because I don't talk, I guess I don't talk to people that really needed it. I mean, there's a lot of people that just did it because it's a good way to, I don't know why. Hey, all right, a payment vacation. And basically, yeah, they're just like, I thought, what the hell, I mean, sounds good. Um, I'm sorry. Um, yeah, I don't know what the answer. I don't know about that. I think you're right, but I just don't know how that works about evictions. Um, I've talked to people who think that they're going to wait until the big market crash. Y'all hear that? I'm going to wait until, and for all the foreclosures. I'm like, there ain't going to be any foreclosures. Yeah, if there are, yeah, I mean, right, yeah. This isn't 2008. People aren't all of a sudden upside down in their house, and you know what I mean? They would just sell the house. So I think, yeah, people think this is 2008. It's definitely not 2008. And I think we're really lucky to be in this area of the country, although I think this is going on around a lot of the country. But what I see, and I'm sure y'all see too, are way more people than even were before moving here, from California, Arizona, of course, New York, Florida. Um, yeah, yes, yeah. Was it? Yeah, right. Because over the last 15 years, sort of this snowball that's been sort of catching steam. Because, you always hear the story. Well, I visited my uncle last Christmas and I fell in love with it. And now I'm back. And now just they told two friends. Well, now I'm dating myself. The old commercial about they told two friends and they told two friends and they told. I mean, it's just crazy. Um, yeah, right. The question was, how long do I think rates will stay low? Well, the Federal Reserve said they're going to keep rates low. That's not mortgage rates. But in general, they're going to keep rates low through at least 2023. I think they're going to stay low. Yeah. I mean, it's almost impossible to say, but what I've noticed over the last 10 years, we've just been waiting for rates to go up, and they just keep going down. I mean, they'll go up a little bit and then they come back down, you know. Now, if they all of a sudden found a vaccine tomorrow and, you know, all these great things happen and the economy just took off, yeah, I mean, rates could definitely go up. But I think they're probably actually a little bit artificially higher than they could be. And you'll notice if you go to like wellsfargo.com or whatever, their rates are higher. Like my rates are, not to talk about how great my rates are, because it's not about rate, but their rates are going to be higher than my rate, or probably most companies like my rates, because there's so much volume in the mortgage industry right now. There's not enough people to you know, work on the loans. So I mean, since March, I mean, operations staffs, everybody, I mean, they've been working weekends. I mean, they just cannot handle the business. So what they do is they increase rates to try and slow down business, because they just can't do it. And yeah, so yeah, that's right. Well, I mean, if you're in the mortgage industry, in the operations side, I mean, you can almost name your price right now, because it takes obviously, like anything, it takes a long time to learn something. They don't have time to train somebody, but if somebody is good, knows what they're doing, I mean, yeah, you make a lot of money. So, but of course, if you went and learned it now, by the time you got trained up, it all end, and you know, it wouldn't be any jobs. So, well, I know y'all have other things probably to talk about today.